Good morning, everyone. Thank you for joining us at our Capstone Coffee conversation. Today's conversation, we're going to get a little bit into the weeds, a little intricate about a topic that we are seeing and using a lot this year, unfortunately, called tax loss harvesting. And before we kind of talk about what that entails, it really is helpful to have kind of a background knowledge on how your investments grow, what types of components feed into the growth of a stock or a bond, and then how you can manage the tax consequences that come with that growth. So that's what we'll talk about today. A little bit of background knowledge first, and then some strategies that we are using and putting into place in 2022, being a very difficult investment year for both stocks and bonds. Financial success is not necessarily about how much your investment might make, but we try to focus on how much you keep of that investment gain, right? If your stocks or bonds grow a lot, but you don't have it in the right account, or you're not utilizing some of the strategies like tax loss harvesting that we'll talk about today, if you're not utilizing some of those strategies, your tax bracket can grow, and the amount of money that you lose off of your investment gain can be much more than if you simply hold the right investments in the right accounts and utilize some of these strategies. So what you keep is much more important in what really matters to you versus what you make on your investments. So people with the same return can have very differing final kind of outcomes if they aren't holding the right investments in the right accounts and utilizing these strategies. So first, let's talk about how do investments grow. And we'll kind of keep it to stocks and bonds today. There's also commodities. There's a lot of, there's new cryptos and things like that as well. But we'll keep it to stocks and bonds, which encompasses the majority of what people are investing in within a brokerage type of account. So stocks and bonds, first off, they can pay, don't have to, but they can pay dividends or interest payments. Okay, so a stock can pay a dividend, but they don't have to. And a dividend is basically a payment for investing in a particular stock. So a company can come out and say, we're going to pay a dividend of 10 cents per share or $1 per share, right? And that's basically a commitment for that company to say, based on how many shares you hold, we're going to pay you a little bit of payment each quarter or each year for holding our stock. It's basically a return of cash to shareholder. So that's a dividend. A stock does not have to pay a dividend, okay? There's some that choose not to, but you can pay a dividend as a stock. A bond can pay an interest payment. Don't have to as well. So there's some things that are called zero coupon bonds, which basically means we're not going to pay any interest. We're simply going to let price appreciation happen in the bond. But most bonds, almost all bonds, pay interest payments. Okay? And that's the same type of thing as a dividend, but it is an obligation of the issuer to pay the bond holder an interest payment, be it quarterly, semi-annually, annually, sometimes even monthly, for a specified amount. Okay? Dividends can change. They change a lot more. You'll have companies, if they're doing really well, they'll increase their dividend. Companies don't like to decrease their dividend, but in significant financial difficult times, companies can decrease a dividend. They can take their dividend away. They can start a dividend. Right? So stocks have much more flexibility with the dividend. On average, companies like to kind of fix a dividend and, if possible, slowly increase that dividend each year. But it's very flexible based on the company's decision. Bond interest is not flexible. It is committed to at the issuance of the bond and then held for that period of time. The only reason that would change is if the company or the government that is issuing the bond files for some type of bankruptcy. Okay? So stock dividends, very flexible. Bond interest, pretty fixed. Okay, so you'll hear us a lot of times called bonds fixed income. We kind of know what we're getting with that income. Dividends have a preferential tax treatment. So when a stock pays a dividend, that hits your tax return as dividend income. And dividend income can range anywhere from 0% up to 20%. Okay? If you are in the 12% tax bracket, your dividend rate is 0. So if you're in, you're paying 12% of your taxes, your dividend rate is going to be about 0. If you jump into the 22, 24% tax bracket, your dividend rate's typically going to be about 15, so you get a little bit of a break. And then if you're in the 30s for your tax bracket, your dividend rate's typically going to be about 20. So dividends get a little bit of a tax break. They can either be at 0, 15, or 20%, but regardless, they are less than your ordinary income tax. So investing in stocks that pay dividends gets a preferential tax treatment versus bonds that pay interest. Bonds that pay interest are taxed at ordinary income. So if I own a bond and it's paying me X% of interest, I get no tax break on that interest. Whatever that interest goes right onto the top of my income for the year, and I pay tax at my ordinary income rate. So that's either 12 or 22 or 24 or in the 30s. Whatever our ordinary income tax is, that's what we pay taxes on our bonds. So there's already a kind of a difference in what we hold, be it a stock getting dividends or a bond earning interest. We'll try to be very careful, and we want to hold bonds, fixed income, in tax deferred types of accounts. If we can hold a bond in an IRA, for instance, that interest that the bond spits out every month or quarter or semi-annually does not get taxed because it's within an IRA. So we get the full benefit of earning income without paying tax on that income. And a stock, many times we'll try to hold that in a joint account, individual account, trust account, a taxable account, because the dividends receive tax preferential treatment. And so what we hold and which type of account really matters. And so we try to line those up, but it all kind of depends on how much you have in each type of account. We want what you want your overall allocation to be, but we'll try to massage that so we hold the right things in the right account. One thing that I kind of caution people on, the dividend payment or the interest payment that you receive from stocks or bonds is what's known as yield. A lot of times you'll see that called yield on your statement. And many people will say, well, look at the yield on that company, stock, bond, what have you. It's 9% or it's 10%. I should buy that. It's earning 9 or 10%. And that is the quote unquote yield for the year. However, that is not incorporating the price appreciation or depreciation. So that's what we're going to get to next. Is I see a lot of, but I just kind of want to throw a caveat out. Just because a company has a higher yield or a bond has a higher yield does not mean it's better. If it was that simple, that would be great. Okay, but it's not that simple. Okay, so paying up or buying something with just a higher yield doesn't mean it's better. But that's what it was referring to when it says yield. What is the annual dividend or interest payment on that stock or bond? And before I go further, think of a mutual fund or an exchange traded fund, an index fund, as just a package of stocks or bonds. So a mutual fund, if it's a stock mutual fund, it's going to kick out dividends based on all the stocks in it. And if it's a bond mutual fund or index fund, it's going to kick out interest based on all the bonds that are in there. But a mutual fund or an index fund is simply a package of whatever it's holding. Okay. The other way that investments grow is through price appreciation or depreciation. And stocks and bonds are all moving every second, right? Every month, every year. The price is changing up and down constantly. What you see in the price appreciation or depreciation is called an unrealized gain or loss. And basically that means I bought XYZ company at $100. Today it's worth $110. I now have an unrealized gain because I bought it for a certain price. It's worth something more than that. That gain is unrealized, meaning it's sitting in my account, but I've done nothing with that gain yet. My account has grown. I have not realized any gain because it's simply paper gain so far. Okay. And same thing on the paper loss. If I buy an ABC company for 100, it goes down to 90. I have an unrealized loss. Okay. Same thing with a mutual fund or a bond. Bonds can go up and down too. As we've learned this year, they do go down. it is possible, and this is very confusing to people, it is possible to hold a mutual fund with an unrealized loss that has done very well for you. Okay, and so I'll explain that. As you hold a mutual fund, let's say you hold a mutual fund for many years, each year that mutual fund is potentially buying and selling stocks within the fund. And as that happens each year, the mutual fund will kick out a gain to the investors, right? So let's say the mutual fund, even though you bought this mutual fund at $100 and it maybe is now worth 150, if you've made no sells or purchases and you just held that fund the entire time, you've held it for 5 years, that mutual fund each year might have been kicking out a gain to you based on the buys and sells within the fund. So you've been paying tax, a little bit of tax on this mutual fund as it's been growing, even though you have never sold or bought any more of that fund. Then the fund price goes down. Well, you've increased your cost basis. So it's possible to have an unrealized loss, even though you've had funds that have done very well. So just as I caution people to not look at the yield and make the investment decisions based on the yield, when you're holding a stock or a bond or a mutual fund, and you look at the unrealized gain, and maybe it's a big number, positive or negative, do not look at that unrealized gain and think, if it's a big number, it's good, and if it's a low number, it's bad, because there's way more that goes into it than that. You could have done very well in a fund that has a very large unrealized loss. Okay, so I kind of throw that out there. I know this is getting pretty technical, but that's something that we kind of try to analyze and make sure that we understand how the fund's doing and not just simply look at the unrealized gain or loss. A realized gain, and this is kind of now getting into the strategy of this year. A realized gain is when we sell something and we now realize the gain or loss, which is going to be sent to the IRS at year end. So we bought something for 100, it's worth 110, it's unrealized, now we sell it, now we have a realized gain of $10 or 10%, or however we want to think of it. And that figure, whatever amount we've made there, is sent to the IRS as a capital gain. And the same thing works as a loss. If we bought it for 100, price goes down to 90, we sell it at 90, we have an unrealized loss of that 10% of whatever dollar figure was lost there. Okay. If you buy something and hold it for many years and it grows, and we've seen that happen over the last decade. We've seen tech companies do very well for a decade, right, until this year. But they've made a lot of money for many years. And if you are not managing the unrealized gain and doing some tax loss harvesting each year, pretty soon you can create a problem where now you have this stock that is cost prohibitive to sell because it has such big tax consequences that you don't want to sell it, and it becomes very hard to allocate your account in a correct way because you might have an individual position that's grown to be 4, 5, 8, 10% of your account as you've never been managing the tax consequences of that. And now it becomes almost like, well, I'm going to hold that till I pass away, and my account's always going to be unbalanced because I've never done some of the tax loss harvesting. So utilizing tax loss harvesting enables us to keep an account allocated correctly and having an investment that doesn't become a never sell because you don't want to pay the taxes and it just becomes an estate problem. And if you hold something until you pass away, it can be a good strategy for your estate, because then your estate receives a step up in basis. They don't have to pay tax on that gain. But you might be living for a long time with this gain for many years that you now becomes a position that you are just going to hold forever unless you kind of utilize the strategy. So 2022 has allowed us to do a lot more tax loss harvesting than any other year because we're seeing quite a bit of negative movement in some positions. So I'll give you an example. So if you've held, for instance, Amazon for the last decade, it's done very well, even though it's lost a third of its value this year. Over the last decade, it's still made a lot of money. And if you haven't been tax loss harvesting, you probably have a little bit of a problem with the growth of, call it Amazon, Microsoft, T-Mobile, et cetera. Tax loss harvesting would say, well, let's say we bought the S&P 500 last year, right? The S&P 500 today is down about 25%, give or take, based on the day, through this first 9.5 months of the year. Let's say that you want to continue to hold the S&P 500, but Amazon, we'd like to trim. It's become too large in our portfolio. We're trying to take some gains if possible. What we can do is sell some of our appreciated stock and also sell some of our S&P 500 and take the loss on the S&P 500 and the gain on the appreciated stock and marry those together so that we send to the IRS a $0 tax bill, or maybe a very small gain, or maybe a small loss, right? But the goal in tax loss harvesting is to harvest losses to offset gains in other positions to rebalance our account where before we haven't been able to because it's been tax prohibitive. So in tax loss harvesting, you also aren't having to make a concession on what you hold. So if I hold the S&P 500, but I still want to hold it, I bought it 10 months ago, it's at a large loss. What I could do is I could sell this S&P 500 fund and I could buy a very similar S&P 500 fund. And now I'm basically holding the same exact investment, but the IRS now sees a realized loss because I moved from one to the other, realized the loss. I have the same potential gain, same risk tolerance, same kind of holding-ish, but I've moved from ABC S&P 500 to XYZ S&P 500, realized the loss, offset the gain of some appreciated stock. IRS gets a $0 tax bill, and we can rebalance, reallocate account to maybe what we like going forward, not what we liked for the past decade. So that's a strategy that we are using continually. It comes with an unfortunate consequence, which means to do tax loss harvesting means you have to have positions that have unrealized losses, which means markets are down. But in taking advantage of this, we're setting ourselves up for better returns, hopefully in the future, by allocating towards what we want to be holding in the right areas, rather than being forced to hold big positions at 5, 6, 8, 10% because we can't sell for tax purposes. So I know that's a lot, but it is into the weeds, and that's how we try to manage the amount that you keep rather than what you make in an investment. For losses and gains, you can offset each year as much as you can do. And again, this is only in taxable accounts, as IRAs don't matter. You don't send an IRA, your IRA doesn't have a tax unrealized gain or loss that gets sent to the IRS, only in taxable accounts. And you can offset as much gain and loss as you want in a year. If you have more losses than gains, you can only offset the next year. Then you can carry forward $3,000 in losses every year. So if I had 25,000 in losses, 10,000 in gain, well, now I have 15,000 in losses to carry forward for the next 5 years. So I could reduce my income by $3,000 per year for 5 years by creating those losses this year. Next year, if I create a lot of gains, then that fast forwards the losses to be used right then. So you can offset as much in gains and losses as you have, and then you can carry forward any losses, $3,000 per year, if you have more losses than gains. That is a lot. Typically, we stay at kind of a 30,000 foot view, and kind of try and hit on basic market issues and what have you. But this is something we've been using a lot this year. It's a conversation we're always kind of having. And so I thought it'd be a good topic as we approach the end of the year to talk about, when we bring up tax loss harvesting, what does that mean? And I didn't address this at the beginning. I should have, but if you have any questions, I'll have Kennedy and Adriana back here. If you have any questions that you would like to submit about tax loss harvesting and even just markets in general, please hit a chat to the message host, and be happy to take those. If you have any, go ahead and send those in now. I'll take a drink. Mm-hmm.
Okay, so it looks like one question came in, and the question is, what is the timing of tax loss harvesting, and how do I know if this is something I can do for my account?
So timing is any time throughout the year, and so we look at it at the end of the year with clients as we kind of approach. There's a few things on our checklist. If you have to take required minimum distributions from an IRA, but tax loss harvesting is on that checklist as we approach the end of the year. But in years like this, in every rebalance, we are looking at it, because this year with market declines, it's been changing all throughout. Each quarter we look at an account, there's been some pretty wild swings, and where we might be able to harvest one fund for a loss here at this time this year, and then later in the year we have a different fund that we can harvest a loss on. So it's within the year. It's with January 1st to December 31st. It's on our checklist to do by the end of the year. But certain years, like this year, which has been very challenging, it's something we've been continually doing throughout the year. And the account type is the other piece on that. It has to be a taxable account. If all of your money is in IRAs or 401ks or qualified accounts, then tax loss harvesting is not on your radar screen.
Another question came in, and it's, how are RMDs impacted by this strategy?
Yeah, so RMDs are not impacted. So an RMD, which is required minimum distribution, if you're 72 and older, you have to take a distribution from your IRA every year. Or if you have an inherited IRA, then you have to take a distribution from that inherited IRA every year, regardless of age. A required minimum distribution is based on two things. It is based on your age and the December 31st account balance. So if I'm doing a required minimum distribution for this year, it's looking at your age this year, and it's looking at 12/31/2021 account balance. That is the amount that is needed to be kicked out to you. Tax loss harvesting is just a strategy to be used in a taxable account to offset gains. Okay, well, thank you for letting me kind of get into investment geek speak, I guess I would call it today, and getting into the weeds a little bit. I appreciate your time. If you have any questions about, is this right for you, contact your advisor. They can say, hey, we can do some, or no, actually we aren't able to. Contact your advisor, and we look forward to seeing you next month for a Capstone Coffee conversation. Thank you.